Hello, active traders. This is Ken Calhoun from TradeMastery.com with a brand new series called the Oil Trading Update. And whenever oil stocks and ETFs and ETNs start to run sharply as they did yesterday on Friday, June 22nd, I want to take a look at some of the charts together. As always, all information is for educational use only. I'm not making advice about what to buy, sell, or hold, and by watching this, you're going to not make actual trades. Let's start off by taking a look at USO. We're going to take a look at six different instruments. USO, UCO, Oil NF, OIH, British Petroleum, and Halliburton. Anyway, USO did a gap up yesterday, 13.6 to 14, starting to move up sharply. We're going to take a look first at the 15-day charts and then the 90-day charts. What I like about this is that it gapped up and continued on up. So this is a very explosive breakout type of a pattern. You can see virtually all of the oil instruments have a very similar pattern. One that I like especially is UCO because the point range is better. It gapped to 29 whole number resistance and broke out all the way up to just around 30.4 in yesterday's markets. Take a look at the 2-day chart. It looks like that. Good strong uptrend continuation pattern to work with. So the reason I want to do this video is oil is all of a sudden starting to skyrocket up, and there may well be lots and lots of upside if this spark of a rally continues. Next up, oil NF. OIH, the oil holders, did kind of a gap up in a bearish cup pattern, but it's gapped up nonetheless, so that's strong. Same type of pattern, British Petroleum gapped up and consolidated to just under 46. It sold all the way down to near 44 and then gapped up to 46. So I want to see if it's able to break out to new highs. And last but not least, Halliburton did a gap up in another bearish cup pattern. So those are the 15-day charts. If we take a look back at the 90-day charts, you'll see that many of them have recovered recent moving average lines, like the 50 simple moving average, the 50 simple moving average, 50 simple moving average is the red line on this 90-day chart. You can see it had sold down. This is a pivot pattern that I like to teach, where you see a large green candle breaking over key resistance area. See the same exact pattern with UCO, with the closing just above the 50 SMA. So that's a buy signal institutionally, especially if we're able to get over the nearest whole number and hold it and then run up to previous resistance. Then who knows where it goes from there. You take a look at the long-term chart. The reason I'm interested in oil is because of this, the trade potential, the profit potential. It had been a few years ago back at split adjusted 340 a share. It's 340 a share, now at 30 a share. So maybe lots of upside potential if oil sparks a rally. Same pattern with oil NF, nice big large momentum green candle breaking above the 50 SMA. OIH is trying to move, not quite as strong, but it did do a small gap up. It did not break the 50 SMA, so that's not as good a candidate. BP did break over the 50 simple moving average, so it's a bearish candle pattern, so not too excited about this guy unless it takes out new highs over 48. And Halliburton trying to come up off its earlier lows. But of these, for tradability, I like UCO because the point range and the volatility and the volume are all really good, and you can see it's got a nice healthy momentum yesterday. So do keep an eye on these guys coming up. I think they can potentially be big movers. So for more, be sure to join my swingscans.com advisory service, or if you're a day trader, tradingtheopen.com. And be sure to visit trademastery.com so you can see additional resources as well. Anyway, until next time, this is Ken Calhoun with our oil trading update, recording this here on Saturday, June 23rd, 2018. Wishing you the best for a successful, profitable trading summer ahead. And until next time, trade smart, trade the best instruments with the highest volatility and tight stops, and let's go get them. Best wishes for success. Bye for now.